Hey, what's going on YouTube? And welcome back to Tech Conversations. I am your host Guillermo. It is April 8th. Let me know in the comment section below how you guys are doing today. As you can see, it is a green day for me, up $640 today, or about 0.7% so far. So we'll see what the rest of the day brings us. Now, just a reminder, we will be doing a giveaway once we reach 100,000 subscribers. If you'd like to enter the giveaway, all you need to do is hit the like button down below. Make sure you subscribe to the channel and let me know in the comment section below what your favorite stock in the market is right now. Now, in today's video, I want to talk about assignment risk. I had a few individuals reaching out to me who were assigned on one of their short positions. And so I want to go through an example and talk about how this all ends up working out. We also want to talk about ways to avoid this in the future. It's not something you should panic about, but it's definitely something that you should understand. Now, guys, one thing I want to mention here is I've been making a lot of videos on different strategies that we can implement. In the last few videos, I have mentioned the risk of early assignment. There was a video I made on the iron butterfly where I did not mention this risk. I apologize for that. I definitely should have included that on there. But in today's video, we're going to cover how we can avoid this in the future. So again, sorry about that. And remember, guys, don't ever exactly copy the trades that I show on my videos. These are just examples that I make right on the spot. They are not meant to be copied at all. So please don't actually copy the trades. More so just take a look at the strategy that we're implementing. Now, with that being said, let's kind of talk about assignment risk here now. So first of all, if you're on Robinhood, there is documentation that kind of talks about all these things, and I'll put a link to this in the description below. So before we jump into the example here, just a couple of things that I want to kind of cover here quickly. So when you're assigned, you're going to have the obligation to fulfill the terms of the contract. When you sell to open an options contract, anytime you sell to open an options contract, assignment is possible. You can be assigned at any point prior to expiration, even if it doesn't make sense. So no matter what strategy you're using, if you're selling to open an options contract, assignment is possible. Now, there's a couple of different scenarios it talks about, like assigned on a covered call, assigned on a cash secured put. We know what happens in those scenarios. Let's focus on being assigned on the short leg of a call spread. So we'll focus on a call spread here. It's kind of the same thing, whether it's a call spread or a put spread. So let's just focus on this one here. So if you're assigned on the short leg of a call spread, you have the obligation to sell shares of the underlying stock at the strike price. In this case, the long leg, the call option you bought, should provide the collateral needed to cover the short leg. So they kind of cancel each other out. So let me explain this with an example. So let's first just quickly understand what buying a call and buying a put really mean. So anytime you buy a call, there's a seller on the other side. There's a seller who is selling you that call. Similarly, when you buy a put, there's a seller on the other side who's selling you that put. Right? There's a buyer on one side, there's a seller on the other side. Now, what does it really mean to buy a call or buy a put? So buying a call gives you the right, but not the obligation to buy 100 shares at the strike price. Buying a put gives the buyer the right, but not the obligation to sell 100 shares at the strike price. So let's say I bought a call and I exercise my right to buy 100 shares at the strike price. What's going to happen? Well, the seller here will be assigned, right? And the seller here in this scenario will have to provide 100 shares to the buyer. So the buyer will end up with 100 shares more. And since the seller is providing 100 shares, the seller will end up with 100 shares less. Similarly, if I bought a put and I exercise my right to sell 100 shares at the strike price, then what's going to happen? The seller will be assigned. The buyer will have to provide 100 shares to the seller. So the buyer will have 100 shares less. The seller will have 100 shares more. That's kind of the basics of this. This is something you should understand prior to trading options. Now that we know that, let's actually take a look at an example and see how this all ends up working out. And so again, we're going to focus on call debit spread. And this is going to be the very similar to a credit spread or anything like that. But let's take a look here. So remember, the call debit spread, what do? We buy a call and then we sell a call with a higher strike. So here we're buying a call at a 49 strike and we're paying $100. Now we're going to sell a call at the 50 strike and we're going to pay $90. So it's going to cost us $10 to enter this call debit spread. Now we're selling an option. Anytime you sell to open an option, there is risk of assignment. So let's say that the buyer who bought this call that we sold from us decides to exercise his right to buy 100 shares at the 50 strike. Well, then we're going to be assigned. Okay, and we're going to have to provide 100 shares to the buyer here. So what's going to happen is you're going to have to sell 100 shares to the buyer. Well, we don't have 100 shares, so we're going to be negative 100 shares. But we are selling 100 shares at 50 strike, meaning that we're going to be receiving $5,000 from the buyer, right? 100 shares times the strike, which is 50, $5,000. So in this scenario now, we're down 100 shares, we're negative 100 shares, but we're up $5,000 that we received from the buyer. Now, though, what happens is that this call you bought will get exercised. And we just talked about what that means. What does it mean to buy a call? Buying a call gives you the right to buy 100 shares at the strike price. So in this scenario now, when this gets exercised, we're going to buy 100 shares. So we're going to end up with 100 shares more plus 100 shares, but we need to pay for those 100 shares. And so how much do we need to pay? We need to pay whatever the strike price was times 100, right? Because this gives us the right to buy 100 shares at the strike price. So we're going to buy 100 shares at the strike, which is 49. We're going to pay 4,900, but we don't have 4,900. So we're negative 4,900 here. So now if we combine these two, what happens? Well, up here, we're negative 100 shares. Down here, we're positive 100 shares. So it ends up canceling each other out. We're 0 shares. Cool, that's good. Now, if we look over here, for selling these shares, we received $5,000. For buying these shares down here, we're paying $4,900. So what happens here? We actually end up with positive $100. And since we paid $10 for this, our net profit actually would be $90 if we're assigned on this call debit spread. We would make a $90 profit. And that's what a lot of you guys saw that had entered the iron butterfly and were assigned, is that you still ended up making some profit. Now, that's basically how this works, right? As you can see, it ends up canceling each other out. It's going to be very similar for credit spread, for iron butterflies, right? Those are just combination of spreads. So that's kind of the basics. That's kind of how this all ends up working out. So again, it's important that you understand how this process works. Now let's jump back here to this article. A couple of other things I want to mention. So if you're trading multi-leg option strategies and then you're assigned on the short position before expiration, there's a couple of other considerations to keep in mind, like decrease in buying power, and you can kind of read why that happens, accounts deficit as well. But I want to focus on early assignments and exercises. So if you're assigned early, the thing here with Robinhood is that they can't process an early assignment before the end of the trading day. Therefore, they can't exercise the long leg until the next trading day at the earliest. And this is because the Options Clearing Corporation, the OCC, doesn't notify Robinhood that you were assigned until the market closes when they process assignments. So that is why you might see your short leg was, or you got early assigned on a short option, but your long option hasn't been exercised yet, because Robinhood can't exercise the long leg until the next trading day at the earliest. And again, that's because the OCC doesn't notify them that you were assigned until after the market closes. Funds and shares from exercises are available immediately during market hours. If you exercise a position after market hours, your exercise will be queued and credited on the next trading day. Now, how can we avoid this from happening, being early assigned? So one thing that I always try to do is don't let your multi-leg strategy expire on itself. Always close it out before expiration, just to avoid any, on very rare occasions where you may be assigned right at expiration. So always try to close it out on yourself. Don't let it expire. Now, the other big thing, of course, and this I have mentioned in my last few videos, again, I apologize for not mentioning it on my iron butterfly video, is dividend risk, right? Options dividend risk. One of the biggest risks when trading options is dividend risk. Dividend risk is the risk that you'll get assigned on your options position the night before the dividend's X date. You can avoid this by closing your position before the end of the regular hours trading session the night before the X dividend date. And so I know a lot of you guys were using AT&T. And you can go online and just search up X dividend date for whatever stock. You can also use NASDAQ.com. That's what I'm using here. If we go over to T dividend history, we can see X dividend date is April 8th, 2021. That's to date. So when it came to this stock, if we were selling any options with this stock, we would have wanted to close out of this yesterday. Okay, so that's something important to always take a look at when you're selling an option. Check for the stock if they have a dividend, when the ex-dividend date is. If it does have an ex-dividend date coming up, you want to close out the day prior to the ex-dividend date, or just ignore or avoid that stock for that week and just move on to a different stock. So that's kind of how we can avoid these early assignment risks, guys. But as you can see, assignment ends up working out. But if you have any questions, definitely feel free to leave them in the comments section below. Again, I will leave a link to that article for Robinhood that explains it more in the description below. Check out the Discord, guys. Link to it is also in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.